Q2 2026 core income of $10.04 per diluted share and over $2.208 billion in net income. All of that fueled by net written premiums, hitting $11.529 billion.
Yeah, and I mean, to really grasp the gravity of those numbers, you have to look at the core return on equity. Travelers posted a massive 24.9% core ROE for the quarter.
Which is just wild because that absolutely crushes their stated long-term management objective. I mean, they've been telling investors to expect a mid-teens core ROE over time. To hit almost 25% means they aren't just beating expectations, they're operating on a completely different level right now.
Exactly. And to figure out how they actually pulled that off, you really have to look at their consolidated combined ratio. They reported an 83.6% for this quarter.
Right. And for anyone listening who doesn't track statutory accounting every single day, let's anchor on that metric. The combined ratio is basically the most critical number for an insurer. It's a lot like a golf score, where par is exactly 100. So if a company reports, say, a 105, they are paying out $1.05 in claims and expenses for every dollar they take in. They're bleeding cash on underwriting.
Yeah, but if that score is under 100, you are printing money from the actual business of insurance even before you invest a single dime of the float. So posting an 83.6% in property and casualty is, well, it's just a massive margin.
It's borderline miraculous in this environment. So how did Travelers actually achieve an 83.6% consolidated combined ratio? Let's get into the margins and the underwriting engine here.
Well, the first thing to note is that 83.6% is a huge 6.7-point improvement from the exact same quarter last year in 2025. And even if you strip out the daily volatility of insurance and look at the underlying combined ratio, it still sits at a really healthy 84.1%.
Okay, so let's break down why those margins look so good. You basically have two main levers driving this: the weather and the actuaries. Looking at the weather, catastrophe losses were $518 million pre-tax this quarter.
Which is still $500 million in damage, right?
Yeah.
But it's a huge drop from the $927 million they took in the prior year quarter.
Right, nearly cutting your catastrophe losses in half is obviously going to help. But, I mean, I have to play the skeptic here for a second. If margins are improving, mainly because catastrophe losses are down almost $500 million, isn't that just getting lucky with the weather? Like,
Yeah.
Is Travelers actually better positioned, or did the wind just stop blowing this spring?
Yeah, it's a totally fair question. It's easy to look like a genius when a storm veers offshore, but this is where you have to look at that second lever, the actuaries. Travelers also saw $578 million in net favorable prior year reserve development across all three of their segments.
Which is a massive number. Explain the mechanics of that for a second. How do you just suddenly find almost $600 million of favorable development in your old files?
It really comes down to the mechanics of reserve development. Basically, it shows that Travelers has been incredibly conservative in its historical loss estimates. I mean, think about long-tail claims, like a complex corporate liability lawsuit. That litigation might drag on for 5 years.
Right, so the company has to set aside cash today, the reserves, to pay for a settlement that might not happen until 2030.
Exactly. And management can either be optimistic and set aside the bare minimum, which boosts their current earnings, or they can be highly conservative and lock away way more cash than they probably need.
It's basically like overpaying your estimated taxes all year, right?
Yeah.
It hurts your cash flow in the short term, but eventually you get a massive refund.
That's a perfect way to look at it. The fact that older reserves are developing favorably by $578 million means those old lawsuits are finally settling, and they're costing hundreds of millions of dollars less than Travelers budgeted for years ago.
So that institutional paranoia is finally paying off. And
Yeah.
actually, that discussion of weather, luck, and risk management connects perfectly to how they are structuring their financial safety net going forward. Let's talk about the reinsurance shifts in the filings.
Yeah, the 2026 catastrophe reinsurance updates are fascinating. They placed a new $750 million catastrophe bond called Long Point Re 5.
Right, and that covers specific storms and quakes stretching from Virginia up to Maine, running through 2030. And they also renewed their standard $1 billion Northeast Property Treaty.
They did. But the real story, the key detail here, isn't what they bought. It's what they didn't buy. Travelers explicitly did not renew the personal insurance catastrophe excess of loss reinsurance treaty.
Wait, really? They just dropped it entirely. I mean, dropping your personal lines catastrophe treaty seems like a massive calculated risk.
It is a huge bet. By dropping that treaty, Travelers is choosing to retain significantly more risk directly on its own balance sheet. They are effectively saving on those massive reinsurance premium costs by betting on the quality of their own internal underwriting.
So they're looking at the soaring costs of reinsurance premiums and deciding, You know what? We fireproof the house enough that we don't need the extra policy. But if Travelers is betting on its personal insurance underwriting to the point of dropping catastrophic coverage, we really need to look at how that specific segment is actually performing.
Well, the numbers out of personal insurance are just an absolute blowout. Segment income was $827 million, which is up 55%.
Wow. And the combined ratio there dropped an astonishing 8.9 points to land at 79.5%. If you drill down into homeowners specifically, it went from a really painful 91.3% last year to a highly profitable 76.7% this quarter.
Yeah, pushing homeowners down into the mid-70s is incredibly hard to do. Now, obviously, a lot of that was driven by the drastic drop in catastrophe impacts we talked about earlier, but still, those margins are what give them the confidence to drop that reinsurance treaty.
Right. They have a profit cushion to absorb the retained risk. But underwriting profit in personal insurance is only part of the story. Let's look at the heavyweight segment, business insurance.
Business insurance is just a monster. Income was $1.198 billion, up 47%. And just to give you a sense of scale, middle market alone accounts for $3.235 billion in premiums.
The metrics that really stand out there are the domestic renewal premium change of 4.8%, paired with a retention rate of 86%. I mean, pushing nearly a 5% rate hike onto commercial clients and having 86% of them just swallow it and renew, that is incredible pricing power.
It really is. It shows how sticky middle market commercial clients are. Switching costs are so high, audits, legal reviews, risk engineering inspections, that businesses will just complain about the 5% increase but ultimately renew for the stability.
Makes total sense. Now, just to cover all the segments, we should note that bond and specialty insurance saw a slight cooling. Income was down 4% to $234 million, and the combined ratio ticked up slightly to 82.8%.
Yeah, a slight tick up, but management liability retention still remains super strong at 88%. An 82.8% combined ratio in those specialized lines is still fantastic.
I like to think of these three segments like a diversified investment portfolio.
Yeah.
You've got personal and business lines acting as your high-growth stocks carrying the quarter, easily offsetting that slight, basically negligible dip in bond and specialty, which acts more like your stable dividend payer.
That's exactly how it functions. It smooths out the earnings volatility over time.
But underwriting profit is only half the story for an insurance giant. We need to talk about what they do with the float they collect, which brings us to the investment portfolio.
Oh, the float is where the real compounding happens. Net investment income increased 14% to $883 million after tax, just for this quarter.
And their total investments sit at an eye-watering $103.2 billion. Dissect that portfolio for us because it's essentially a massive arbitrage machine.
Right, so of that $103.2 billion, 94% is parked in fixed income. We are talking highly rated bonds, averaging an AA3 rating, currently yielding about 3.2%.
And the remaining 6%.
The other 6% is in non-fixed income, things like private equity and real estate, which is yielding around 5.5%.
So explain how the current yield environment benefits a fixed income-heavy portfolio of this massive size. Because when you pay your premium, they aren't just sitting on that cash.
No, not at all. When you have $97.5 billion in fixed income assets, you're basically a massive lender. So as older, low-yielding bonds mature, Travelers is reinvesting that cash into today's higher yield environment. Even a slight yield improvement across a $97 billion base throws off massive, incredibly reliable cash flow.
And that cash flow directly funds their capital return to shareholders, which is highly aggressive. They spent $1.311 billion repurchasing 4.3 million shares this quarter alone.
Yeah, and total capital return hit $1.577 billion, all while keeping their debt-to-capital ratio at a very healthy 20.5%. It's just an optimized financial engine.
So zooming out from this single quarter, how does this incredible cash generation fit into management's broader historical narrative? In the presentation, they had a slide literally titled A Decade of Success.
Yeah, the trend lines over the last 10 years are pretty staggering. If you look at that slide, net written premiums grew from $25 billion in 2016 to $44.4 billion in 2025.
That's a 6.6% compound annual growth rate. And while the top line grew, their underlying underwriting income grew an unbelievable 323%.
Right. And management uses this data to highlight their long-term financial strategy, which they say is all about generating top-tier earnings through meaningful and sustainable competitive advantages.
Okay, I have to cut through the corporate jargon there. I mean, every single company puts sustainable competitive advantages in their slide decks. It's practically a requirement. But I will say, looking at the actual numbers here, the trailing 12-month core ROE of 24.2% at what they call industry low volatility, That actually validates the marketing speak.
It really does. Achieving a 24.2% ROE over a full year without taking on wild, volatile risks is basically the holy grail of insurance. It proves the competitive advantage is real and structural.
Definitely. But I want to leave you with a forward-looking question to ponder as we wrap up this deep dive. If travelers can post a near 25% core ROE in a quarter where they still absorbed $518 million in catastrophe losses, what happens to their bottom line if we see a historically quiet weather season?
The profitability would just be astronomical.
Exactly. But conversely, considering they just dropped their personal insurance catastrophe reinsurance treaty, they're flying without a net in that segment. How exposed is this incredible cash flow machine if a massive, unprecedented event strikes outside their heavily reinsured Northeast corridor? It's a high-stakes balance of risk and reward.
It certainly is.
Be sure to follow the show for our daily earnings coverage.